Good morning, everybody. Monday, May 12th, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macro and economic commentary, market and economic commentary, excuse me. I can be reached intra-week or seen intra-week if we've got something to say on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation is designed to be used by financial advisors as well as their clients, but they are all expected to make their own investment decisions. Nothing in this presentation should be treated as advice, tax advice, a recommendation for the purchase or sale of any securities. Everything is for informational purposes. The views expressed herein, by the way, are mine and mine alone, may differ from the views of CFIA's parent affiliates or other portfolio managers at the firm. Well, we had a mixed week in equities last week, as you can see. Large cap, after a big week, the prior one, quite frankly, down about 0.5%, while small and mid cap stocks were up, and emerging market stocks were up. There's a little surprise. Kind of, not much change there in fixed income, except for longer dated treasuries gave up about 0.75%. Okay. Remember the prior week, I gave you the manufacturing PMIs. Remember manufacturing, about 15% of the U.S. economy. Services, much bigger, or non-manufacturing. S&P Global Services reported last week for the month of April, came in at 50.8. So anything above 50 means the sector grew. So 85% of our economy, according to this metric, grew. Not by as much as it had been in some prior months, causing some people to question whether or not a slowdown might be coming a little bit. Maybe. I don't think so. We got the ISM services reading, which actually poked up a little bit higher. You can see over here on the right, that rose to 51.6. New orders, 52.3. Business activity, 53.7. That was strong, but down a little. And employment, back to 49. We needed to go to 50, obviously, to do particularly well. Then we got the March trade deficit. Now remember, look at the right here and see how massive these numbers are. We're looking at 120, 140 billion dollar trade deficits. These are subtractions from GDP. Remember when we got that GDP number for the first quarter, and there was a lot of imports that came in ahead of expected tariffs. That was a negative contributor. The markets quickly, after a half a day of trading, looked beyond that and said, we'll look at final sales to end users and consumers, and everything was fine. But we're going to get that again in this quarter, right? So this was the last month of last quarter. Great. But then we've got April, May, and June. We still have some tariff issues. I think mostly it was first quarter, but there could be some lingering effects into second quarter. Then we got consumer credit. Consumer credit was up $10 billion in the month of March. Revolving credit up almost $2 billion after declining the month prior. Weekly jobless claims, exactly as expected, came back down from last week's 241 to 228. If you remember last week, the New York teachers and all the staff at New York schools, they are allowed to file for unemployment and collect unemployment while the kids are on spring break and they get their salaries. Anyway, that is out of the system now. It was a 1 week deal. It's passed. Continuing claims, right around 1.9 million still in that. We are getting to the end of Q1, at least calendar Q1, earnings season. And through Friday, May 9th, 451 of 500 companies have reported. 346 have exceeded expectations. The average earnings surprise, almost 8.5%. That was the big question for Q1. Will earnings surprises be less? Will the beats be less than this percentage, 70% almost, more than 70%? Will that change in Q1? And it didn't. And that's one of the reasons the market is rebounding sharply. The fears of lower guidance have passed. The fears of earnings challenges have passed. And the markets are now, of course, rebounding from the sell-off related to the initial shock and awe of the tariff situation. In fact, markets have started to get a little bit expensive. This is the blended forward PE, price to earnings ratio, of some indices I selected for you. We start with the S&P 500. It's up to 20.5, and of course the market's up as we speak right now. We're up about 1,000 Dow points, about 100 S&P points. So that number's higher even as I'm recording. Mid and small cap stocks remain cheaper, more reasonable, 15 multiple on mid. Small caps got a multiple just under 15. You can see both of those here. Developed international at 14 and emerging markets down at 12. You know, it's interesting. Why is the S&P so much more expensive? They're bigger companies. Presumably bigger companies can't grow as much. You have more growth in smaller companies and it's cheaper. Does that make sense? It does make sense because what's happening is big cap tech is got a big moat around it. It's well protected, recurring revenue, fortress balance sheets, and that is the preponderance, and communications and tech combined is the preponderance of the S&P 500. These companies are awesome. Big monsters, big protective moats, and they're commanding high multiples, and the earnings just keep coming in. So we'll see. We'll see. There will be a time, yes, I think when you get into a recession and small cap gets really cheap and you're betting on coming out of that recession, that's a great time to increase your weighting there. But right now, I think being overweight in large cap and large cap tech continues to be the way to go. I am starting to see some compelling value here. Emerging markets. Countries like India and China, if they can get productive, positive, fair, free trade deals, I think they're going to end up better off. Right now, I do agree with some of the administration saying that the trade deals have been sort of unbiased towards particularly emerging markets, but that's part of international law, right? They get to do some things the rest of us can't do. That's a whole nother presentation. But as they continue to develop, starting out at a 12 multiple, if you see some recovery in places like China, eventually you could see some value there. We are not there yet. I'm not ready to increase my EM weightings, but I like the valuations. So back to valuations, and let's talk about our market. As of just a few moments ago, the yield on the U.S. 10-year Treasury, 443. That is risk-free. You put your money in U.S. 10-year Treasuries, you hold them for 10 years, you get 4.43% without risk, and that's pretty darn good. Now, on the other hand, if you buy U.S. stocks as measured by the S&P 500 index, the PE flipped over is earnings divided by price. We call that the earnings yield, 4.13. Traditionally, you want to get paid more to own stocks, right? You want to get a higher yield because we call it the equity risk premium. But for the better part of the last year, you've got paid better to own fixed income or 10-year U.S. Treasuries. You don't have the volatility, you don't have the risk. All of that is happening. And we sort of got to fair a couple weeks ago, and I pointed out to you, and now we have a pretty sizable gap, about a 30 basis point gap. So stocks are not cheap. Stocks represent all of the growth opportunities in our economy, whether it's related to healthcare or artificial intelligence or Web 3.0 or blockchain. Any of these things are represented in equities and earnings growth. So when you see this, either the stocks are overvalued, maybe, bonds are undervalued, probably, or earnings growth expectations are higher than we think, and the S&P 500, remember the yield on your 10-year Treasury is fixed, but the yield on your S&P 500 stock investment, the earnings are expected, as a general rule, to go up on average every year. There are years where they go down in recessions, but on average every year. So over the next 10 years, let's just say earnings grew at 7%, you could expect those earnings to double. So the market is saying we're confident in earnings growth going forward, so much so that we're willing to bid that PE multiple up to 20 times next year's earnings. And the other thing that's got us all on edge, wondering what's happening, is what's going on with the Federal Reserve. When will the Fed resume rate cuts that they began? Well, they really can't until the inflation number gets under control, and we're going to talk about that a little bit here, one more slide. But as of right now, this blue line represents what the futures markets expect the Fed funds rate to be in the future. You can see the expectations are for it to go down. So for example, let's just say, September, October timeframe right here, the expectations are for about a 4% Fed funds rate. That's obviously down from the level that we're at today. So the market is expecting these cuts. The cuts are noted here at the bottom of my screen. Okay, you can see here. And what I did is I took a snapshot. What was the number a month ago and what is it today? And you can see the expectations for cuts have all gone down pretty much along the whole curve. It's shifted higher rates. So they're not baking in as much of a downward fall in inflation or a need for cuts because maybe the labor market is having issues. Move on, let's talk about inflation. We have seen the 2-year inflation break even. That's the tip minus the nominal yield, or the nominal yield minus the tip rather, that spread is what the market believes inflation will be. And until these numbers come down meaningfully, I don't think the Fed's really in a position to be able to cut rates. So you can see we peaked out about 3.4% just a couple of months ago. We have come down considerably, 2.66, bumped higher, and now bound 2.64 this morning. And there's something very interesting going on with the way the administration is attempting to wrangle in inflation. We've gotten sort of over-reliant on the Fed. Hey, well, it's the Fed's job, right? The Fed has to tackle inflation. And really prior to the Fed getting that mandate from Congress, it was everybody's job to handle inflation. And the Fed got the mandate. It was only to help and assist. And then it became exclusively the Fed's purview. And the government decided, well, we can spend into oblivion, deficit spending. If it causes inflation, that's the Fed's problem. And I think this administration is saying, no, we're going to take back this problem and we're going to face it and we're going to address it. And they've shown us that they have a strategy to do that. The first element of those strategies is they want to target energy costs. You've heard both the president and the vice president talk about this excessively. We need to bring down the price of energy. That brings down the price of transportation and manufacturing of just about everything, right? Petroleum and energy goes into every single part of our lives. And they have coordinated now with OPEC. They had an announcement last weekend. You all saw that. And by using Strategic Petroleum Reserve to try to push fuel prices down. And it's a very volatile and heavily weighted CPI category. So we have seen that start to happen. Number two, we saw an executive order get signed this morning after an announcement yesterday. It's an action designed to reduce prescription drug prices, including Medicare negotiation powers. Want to curb all of the healthcare-driven inflation, which is a massive component of the PCE price index. So again, rather than focusing on the money supply and interest rates, which they can't do, that's the Fed's purview, so they're right to stay away from that, but they're also right to try to help, to try to get involved, to try to get something done. On housing, another big component to inflation and rents, they have federal now initiatives to expand the housing supply, some zoning reform, builder incentives, HUD support, targeting rent and shelter costs. That is the largest component in the CPI. And they've attempted to introduce measures to improve food supply chains, crack down on price manipulation in places like meat packing and so forth. We are seeing the markets begin to react to that. If we get a couple of more months of decent CPI and PCE data, and this chart right here continues to decline down and to the right, then the Fed will be in a situation where it is all clear and they can reduce interest rates. This is a very, very positive development on the inflation side. Okay, in terms of data this week, we've got the federal budget balance for April expected to be at just $256 billion. Small business optimism for April at coming in at 95. CPI 0.3. Remember last month was negative 0.1. So this could cause some consternation on inflation again. Nothing big on Wednesday. Weekly jobless claims, retail sales, PPI New York manufacturing and Philly Fed, industrial production utilization, housing sentiment on Thursday, housing building starts, import export prices, and consumer sentiment all on Friday. Well, this is available on YouTube. Best place to catch it because you see all these great graphs and charts. Or if you're just driving around, you don't want to look at a screen. Do not look at a screen while you're driving, please. You can find it on any of the podcast formats, Apple, Spotify, etc. I'm Herb Morgan. This is Slaying Bulls and Bears. We want to make the complex and complicated simple and sensical. Thank you, everybody. I'll be back to you again next week.